Welcome to Talking Business, a podcast produced in Melbourne, Australia. The podcast is available on the Acast app, the Apple Podcast Store, or wherever you go to get your podcasts. Or you can get it at the Business Acumen website at www.businessacumen.biz. I am Leon Gettler. My job is to review and monitor the week's news in business, finance and economics. I bring it all to you every week. This is episode number 8 in our series for 2022, and today's date is Friday, March the 25th. First, I'll be talking to Brendan Doggett, Country Manager for Sharesies AU, on how investors are now responding to market upheaval. And I'll be talking to Indeed economist Callum Pickering about the latest jobs figures. But now let's talk to Brendan Doggett. Now, Brendan, tell us about the markets at the moment. People have to get used to war going on with Russia and the Ukraine. I mean, how's that affected the market and investors?
Yeah, the market's definitely had an interesting run over the last little while. First pandemics and now kind of threat of war, I think. But the one thing is the markets are resilient, but the markets don't like uncertainty. So anything to do with kind of geopolitical stuff puts a bit of a scare in the markets. Also impacts consumer sentiment, which, people just don't want to get trading. The prices are going all over the place, but it's impacting commodities, oil, tech companies, airlines and all that sort of stuff. So it really is like an amazing combination of kind of external forces playing out for us right now.
Yes, indeed. And the question is, are there any safe havens?
Yeah, good question. I would say there aren't really any safe havens apart from good old fashioned investing in an ETF, which tracks an index over time. That's been seen as quite a good way to grow your wealth fairly conservatively. I think the ASIC 200 over 10 years has kind of returned about 9%, including dividends. So you park your cash in there and that's a nice little safety thing. I think there's lots of uncertainty. We've had a bit of a bounce in the market today, but what is a safe haven? It's kind of, there are some speculative stocks that you can kind of look at, but for my money, it's like park it in an ETF and kind of let the market do its magic.
That's quite extraordinary, and so it's very unsafe for investors, isn't it? Very insecure.
Yeah. I'd say I think the markets over time have gone up and down continuously. I think if you kind of look back to the world wars, there's been 50 odd kind of market corrections which go up and down. If you buy continuously over that time, then it's all good. But uncertainty in markets does create price opportunities as well, you could say.
So there are some bargains out there.
Yeah, some bargains out there, definitely. I always say track the index for a good portion of your investment dollars, but then also think about what companies and industries that you believe in the products and you think there is a future for their products. So commodity lithium is doing pretty well at the moment. So some lithium miners, we've got lots of kind of metal producers in Australia, which have got good, once the supply chain issues are solved, there's lots of customers around the world who still need our metal out of the ground. So there's lots of future opportunity in those spaces.
Well, you'd say that with all the issues with oil at the moment, you'd say companies like Santos and Woodside would be doing quite well too.
Yeah, and we see, our investor base kind of getting into those sorts of things. Look, reading about getting interested in what's going around the world and thinking, what things do people need? And Russia is a big producer of oil and gas, including kind of wheat and other food commodities. So people need to eat, people need to put fuel in vehicles. There's always going to be demand for that.
And so, but what's interesting, is, we've had, last year we had all this stuff, or since 2020, we've had all this stuff with COVID affecting markets. Now we seem to be getting used to COVID or dealing with it, and now we've got with geopolitical stuff happening. And so this is just mind-boggling for investors.
Yeah, it absolutely is. And particularly, Sharesies is all about making people feel more confident in investing and giving them information. So when people get into the market for the first time and all of a sudden, COVID's happened, geopolitical issues, inflation, interest rates, all these really complicated things coming together, people get worried. Money's a very personal thing. People don't want to make mistakes. People want to usually get good returns, but the markets do go up and down. So we see platforms like Sharesies have a very important role to kind of talk to people about that. The market has a cycle. There are ups and downs. The idea about buying regularly over time and dollar cost averaging is just that. You get the peaks and you get the dips, and over time that evens out. But we've really focused on kind of that education content and communicating with investors a lot, saying, remember why you invested in the first place, that you're looking at a 10+ year horizon. Things go up and down. Just fear is part of the market, but just learn from that. And you don't lose money until you sell. So that's an important thing that people need to remember when they're staring at that negative 2%, 3%, 4% and thinking about it. It's like, well, if you need the money, you can sell, but that's the only time you actually make a loss, when you sell.
Well, the interesting thing is, how does Sharesies actually deal with this, with the investors? How do you talk to them? I mean, what communications channels do you use?
Yeah, like in the past, I think a traditional kind of stockbroking relationship was a little bit less communicative, but now we're set up very digitally, and obviously we have everyone's mobile numbers and emails so we can communicate them regularly. We do 3 times a week newsletters, as well as Instagram and Facebook are very, very easy way to reach our customer base. And so you can put up snippets of information in there and kind of helpful hints, give people a little bit of reassurance, and then can point them in the direction of other educational and knowledge information.
Okay, so it's basically your communication is digital mostly.
Absolutely.
Okay, so how are investors reacting to all that volatility?
Yeah, so we definitely have been looking at the data, and it's still over 90% of our trades are buys. So we've got very little people selling activity, which is great. And people we have surveyed recently are overwhelmingly in it for the long term, with an investment horizon of over 10 years. So we've seen almost no panic buying. Some of our comments into our investor care team and through our social media, just about people reassuring each other, not people panicking and thinking, this is a horrible situation. Remembering back when COVID kind of first hit 2 years ago, there was a very big dip straight away. So this choppiness of the market, people are also becoming accustomed to it. And over time, as we know, the markets do it quite often.
So people have got used to that as well.
Yeah, I think used to it. And actually, people understand that the markets go up and down, but it's not always one way. And volatility is, lots of people brought in when the market was on sale basically during COVID. So they realized that ups and downs occur, and sometimes the downtimes are actually the opportunity. The markets are the only place when it's on sale, people start running away from it. Whereas, if the local supermarket's on sale, people will go. So that psychology is actually changing, I think, as kind of we democratize investing.
So who's your base?
Yeah. So we, we're a digital first app, which is no jargon and easy to enter. So we skew younger. So the majority of our customer base would kind of be between 25 and 45, but we have people from 18 to 90 using the platform. It's quite easy to use, and people just feel comfortable with that and like the education content. But that big base is kind of the 25 to 45-year-olds. And we're at the moment about 58% female and the rest male.
That's interesting, 58% female.
Yeah.
How do you explain that?
I think it's all about how we started off Sharesies, which was breaking down barriers and confidence to become an investor. So when we first started off in New Zealand, I think the typical profile of an investor was, an older person living in a capital city who'd been in the finance industry for a while and already had a decent amount of income. So everything we've done has been to break down those barriers. So I think that really speaks to people who've just never invested before. And women have definitely been left out of the financial environment for quite a while, particularly investing, which was, sometimes seen as a bit of a bro culture environment.
That's very interesting. So that was very much quite a select group of investors.
Yeah, back in the day, it was high cost to entry, big no minimum trade sizes over $500. You needed to sign off on your risk profile that you'd invested before, you knew what you're doing, and then kind of put in big amounts of funds based on where do you get your research from. That was also kind of a closed shop.
The $64 question is, do female investors react differently than male investors?
I think that is an interesting question. And from our data, it's pretty much like just a way of thinking about investing. So people who haven't done it before are really involved in doing the research, making sure they're diversified and interested in that. I think the long-term investing profile, probably the same over both genders. I think there's a particular other types of access to trading. Some of the apps are more kind of Wolf of Wall Street or trading kind of behavior, and they might approach a different type of investing, so you're day trading or something like that. Whereas our platform is really about long-term wealth development. So that kind of attracts people who are in it for the long term, investing regularly, interested in the diversification and kind of research. So I think that kind of attracts the customer base rather than by gender.
So you're not really catering for day traders?
Well, so I think day trading is, you need to access funds quickly and kind of buy the dip and the peak. The platform, you can do it through that, but I think it's just a way of talking about wealth, which is kind of longer term, and that kind of is where our platform resonates.
So what are the long-term trends you see?
The long-term trends actually feel quite stable. So we kind of have been watching the companies that our investors have been buying over the last 2 year to 3 months, and it hasn't really changed very much. It's all the usual, particularly in Australia, all the usual blue chips that people get into, some tech, Tesla, some airlines, buy now, pay laters, that sort of stuff, as well as ETFs for particularly US exposure and the index in Australia. And that really hasn't changed over time. The supermarkets are still in there, your value-based companies, and a bit of tech splattering in there. So although you'd think people might react a bit of a knee-jerk to what's going on in the markets and change from tech to banks and back and forth, people are actually investing in the same sorts of companies over time. So it feels boring, but it also is great that people are committed to why they invested and they see value in companies, and they're following names that they know and they can easily kind of research.
Okay, well, that'll be fascinating to watch. And look, thank you very much for your time.
Thank you for yours.
And now let's talk to Indeed economist Callum Pickering. Callum, the latest unemployment figures are very good. They're down to 4%. We haven't been there since February 2008.
Incredible set of labour market figures. Like you said, we haven't seen an unemployment rate of 4% in 14 years. The labour market has strengthened considerably. Over the past 12 months, it's rebounded really quickly from the Delta-related restrictions that we had late last year. This was a labour market report that had very few weak points at all. We're seeing very strong employment growth. We're seeing very strong full-time employment growth, and that's translating into the tightest labour market that Australia has seen since at least 2008. And I think it is very likely that we will see an unemployment rate beginning with a 3, potentially as soon as next month. So this is a very exciting labour market right now.
What's driving that?
Well, it's mostly been driven by the tens of billions of dollars injected into the economy throughout the pandemic, through policies such as JobKeeper. Now, those policies kept the economy afloat during those lockdown periods, but a lot of that money is still flowing throughout the economy. And what that has done is it has created incredible demand for goods and services, and that's underpinned the strong employment growth that has driven the unemployment rate down to this 14-year low.
Okay, so was there a lot of full-time work being created?
Yeah, absolutely. In February, full-time employment increased by around 120,000, which is an outstanding result. Full-time employment has accounted for a little over 90% of all jobs created over the past 12 months. And we're talking about employment growth of about almost 400,000 over the past 12 months. So that's an outstanding result. And what that basically means is that the economy is not just creating jobs. It's not just creating part-time or casual or freelance types jobs. It's creating full-time, high-paying opportunities that is meeting the needs of workers. And a consequence of that is that the rate of underemployment in Australia is also now at a 14-year low of 6.6%, compared with a high 8% range that we were at before the pandemic began. So more people are finding work and more people are finding the hours that they want.
I noticed that female unemployment has dropped to 3.8%. What's driving that?
Well, when we see a bit of a variance in male and female unemployment, and right now the women's unemployment rate's at 3.8%, for men it's at 4.2%. Usually what is driving that is that jobs growth is being concentrated in industries where women tend to be more concentrated. So we're talking about things such as retail, hospitality, healthcare, social assistance. We're probably seeing very strong employment growth in those areas, and that's driving women's employment. The end result of that, as you said, 3.8% unemployment rate is actually lowest since 1974, so a 48-year low, which is an incredible result.
That's quite extraordinary, and of course the issue though too is whether any of this is going to translate into higher wages. I mean, at the moment it's running at about 2.3%, and will this tighter labour market translate into higher wages?
Well, the expectation is that these tighter labour market conditions will begin to drive greater wage competition across businesses, and that should help to push wage growth up. The last time we had an unemployment rate of 4%, wage growth was actually 4% itself, which is in stark contrast to the 2.3% rate we're currently at. So there's still a long way to go on the wage front, but we would anticipate that the incredible tightness in the labour market, the very strong demand for workers, the record job creation that we're seeing, the record number of vacancies, should translate into greater wage pressures over the course of this year and next.
Well, the interesting thing is I notice the unions are now talking about having wages campaigns at 5 and 6%, which would suggest wages will indeed go up beyond 3%. That'd be right?
Yeah, unions are a key part of the equation. So much of wage growth is driven by the minimum wage, various award payments, all of which unions play a big role in determining. The fact that unions are pushing for higher wages makes a great deal of sense given the heightened inflation environment and given the tightness in the labour market. They're seeing an opportunity to get better wages for the people that they serve, and this is an opportunity that they really haven't had over the past 14 or 15 years. So they're trying to strike while they're in a very favourable bargaining position.
So we can expect wages to go well higher than 3%. That'd be right?
Well, potentially. I mean, it does depend on whether the unions are successful in what they're pushing for. There's always a bit of bargaining, a bit of negotiation that takes place, and they don't always get what they want. But the fact that they are asking for much higher wage gains now compared with before the pandemic does indicate that we're likely to see much stronger wage growth over the next 2 years than we've perhaps become accustomed to. And it's going to be necessary because we are in this higher inflation environment. So if wage growth doesn't pick up, then the reality is that the household budgets aren't quite going to go as far as they have in the past. If you're getting 2.3% wage growth and inflation's pushing 4 or maybe 5%, then you're effectively going backwards. And so it'll be interesting to see how these negotiations with the unions, how that results and what sort of wage gains we do begin to see for workers.
Well, that's going to be interesting because the RBA's minutes say that they're expecting inflation to go way higher than the underlying rate, and so some economists are talking about inflation as high as 5%.
Well, that's certainly what we've seen overseas. The Australian inflation experience so far hasn't matched what we've seen in countries such as the United States. That over in the United States, they're pushing about 7% inflation. There's an awfully good chance that inflation in Australia will continue to rise. We'll continue to import high inflation from abroad. We've seen what's happened with global supply chains and key commodity prices such as petrol, all of which point to a higher inflation over the coming months. It'll be interesting to see just how that plays out, whether that is sufficient for the Reserve Bank to raise rates sooner rather than later.
Well, so when are you expecting the Reserve Bank to raise rates? I mean, the Reserve Bank is now coming under a lot of pressure. The Fed just raised its rates. So where do you expect the Reserve Bank to be? I mean, do you see rates being raised in August?
Well, it's an interesting one. I mean, if you just look at the labour market figures, you would swear that they should be raising immediately. But it is still a very uncertain economic environment given the pandemic and some of the geopolitical risks around the Ukraine-Russian war. So the fact that the Reserve Bank is playing a little bit cautious does make a certain degree of sense. But there is increased pressure on the Reserve Bank, and if they do see that further pickup in inflation, I think there will be more calls for the Reserve Bank to hike rates. What we don't really know at the moment, though, is what is the Reserve Bank's threshold for inflation? What level of inflation are they willing to tolerate? Because we know that they don't want to hike rates. They want wage growth to pick up before they hike rates. But the reality is that if we do see inflation beginning with a 4 or a 5%, then it will be very difficult for them to hold steady and push back against that, given the sort of growing pressure that they would be facing. Now, we don't know what their threshold is. We don't know what they're willing to tolerate, but I think we're probably going to find out what that is over the next 3 to 6 months. I'm penciling in an August rate hike, but I think if inflation comes in really hot in April when we get the March quarter results, then I certainly wouldn't be surprised if maybe they pull the trigger in May or June.
And indeed, depending on what happens with the war in the Ukraine, petrol prices keep increasing. And inflation keeps rising. We could see other rate hikes into next year as well.
Well, that's certainly a possibility. No one knows how this is going to play out, but it's going to have a big impact on what monetary policy looks like. If the supply chain disruptions and these geopolitical risks sort of subside sooner rather than later, then it's likely that inflation is just going to spike high and then return to normal levels pretty quickly. And if that was the case, then it wouldn't make sense to respond with tighter monetary policy. But if these are impacts that are going to last into, say, 2023, then we're looking at a more persistent period of very high inflation. And if that's the case, it does make sense for a central bank intervention. So this is the sort of difficult decision-making that the Reserve Bank has to deal with at the moment. You know, there is a heightened amount of uncertainty that is going to have a big role on how the economy and monetary policy evolves over the next year or two.
And indeed, with rising petrol prices, it's very similar to rate hikes. I mean, it just means people spend less, and that affects demand, it affects the economy.
Yeah, absolutely. When the prices of non-discretionary items go up, it is basically like a rate hike. It's very difficult for households to substitute away from those expenditures. So when petrol prices increase, what it largely means is that the consumption of other goods and services tends to decline. And that's ultimately not good for the economy. So one of the things that I think the Reserve Bank would be thinking about right now is the very real risk that this high inflation environment leads to a slowdown in economic activity. The economic response from an inflation event that is being driven by supply factors is very different than what we would see if inflation was being driven by higher wages. A supply-driven inflation shock typically leads to lower spending, lower economic activity, so it's an overall negative for the economy, whereas an inflation event that is being driven by rising wages, that tends to underpin stronger demand for goods and services. It's actually that stronger demand that is driving those prices higher. So it's a very different dynamic, and the Reserve Bank would obviously be well aware of sort of the risks that they face in increasing rates in that environment, because that is only going to increase the pressure on household budgets, which are already being pushed pretty heavily by what we're seeing with increases in petrol prices and other commodities.
Well, Callum, that's all very important. Thank you very much for your time.
Thank you, Leon.
So what's happening in the news? Well, as prices of basic foodstuffs and fertilisers continue to surge, economists are increasingly concerned that Russia's invasion of Ukraine could spark a vicious wage price spiral that will force central banks into more aggressive interest rate rises. The conflict has plunged the global food market into disarray, as Russia and Ukraine are key exporters of foodstuffs such as wheat, corn, barley and sunflower oil. Over the past 5 years, the two countries together have accounted for nearly 30% of the exports of the world's wheat, 17% of corn, 32% of barley, a crucial source of animal feed, and 75% of sunflower seed oil, an important cooking oil in some parts of the world. Prices for key agricultural commodities have jumped sharply since the invasion, as Russia has blockaded the Black Sea, cutting off Ukrainian crop exports, 85% of which are transported by sea. With ports closed, Ukraine has shifted to less efficient and more costly rail transport. Meanwhile, Russian food exports have been hit hard by Western sanctions that have cut the country off financially. Russia is hit back by halting exports of ammonium nitrate, a key fertiliser for which Russia accounts for 2/3 of the global market. The war in Ukraine has compounded the existing disruptions of global food markets, which have been caused by the coronavirus pandemic, shipping delays and rising freight costs, as well as droughts and floods in major food producers. The combination of these factors have pushed up wheat prices by 40% so far this year to fresh record highs, while corn prices have risen by more than 27%. There are also growing fears that this food inflation will persist, as the ongoing war in the Ukraine makes it unlikely that more than 1/3 of Ukraine's cropland will be planted this year, given the country's farmers face shortages of fuel, fertiliser and even labour as farm workers quit to join the Ukrainian Defence Forces or to leave the country. Because grain is used for animal feed, surging prices are also pushing up the price of meat and milk. Food inflation is also being stoked by the surging price of oil, which is crucial for food packaging and transportation. Even before Russia's invasion of Ukraine, the global supply of milk was already under pressure, as bad weather in New Zealand, Australia and the United States had reduced output, while the surge in oil prices lifted transportation costs. Another longer-term shock to the food markets is the growing shortage and rising cost of fertiliser. Russia is the world's largest fertiliser exporter, providing about 15% of global supply, and Russia's ally, Belarus, a leading producer of potash-based fertiliser, has also been hit with sanctions. And consumer confidence plunged 4.8% last week, according to ANZ Roy Morgan, falling to its lowest level since early September 2020, when Victoria was suffering its second wave of COVID-19. Weekly inflation expectations rose 0.4 percentage points to 6%, as petrol prices continue to surge, taking the 4-week moving average to 5.5%. Current financial conditions decreased by 5.4%, and future financial conditions fell 4.6%. Both indices were at their lowest levels since July and April 2020 respectively. Increasing petrol prices have had a sharp impact on households' confidence for both current and future financial conditions, with the two sub-indices dropping 10.3% and 8.4% respectively over the last 2 weeks. And Treasurer Josh Frydenberg on Monday released a new consultation paper on the cryptocurrency industry, seeking feedback on digital asset regulation, including input on a licensing and custody regimen and the classification of digital tokens to provide more certainty to crypto providers, consumers and regulators. More than 800,000 Australian taxpayers have used some form of cryptocurrency in the past 3 years, up 63% the last year alone, while some Australians have lost tens of thousands of dollars worth of crypto with the collapse of local unlicensed exchanges. And next week's federal budget will contain measures to deal directly with high petrol prices, either through a temporary reduction in the fuel excise or a freeze on its index increases. Prime Minister Scott Morrison all but confirmed on Tuesday that help was on the way regarding prices at the Bowser, not because of their direct impact on household budgets, but because of the flow-on costs to businesses. The fuel excise relief will be part of a cost of living package in the budget, which will also include modest one-off payment to low and middle income earners and possibly welfare recipients. It is understood the excise cut will be temporary. 3 months will be too short and regarded cynically as something just to get the government past the election in May. On the other hand, 12 months will be too long in terms of lost revenue. In the run-up to the 2001 election, John Howard froze the indexation of the petrol excise, although it had no immediate impact on prices, which had just broken the $1 per litre barrier. It sent voters a message that the government was listening. And 1/3 of Australian companies expect to miss their 2050 net zero carbon emissions, according to research released on Tuesday by Microsoft and the University of London. 686 Australian business leaders and thousands of employees took part in the survey, which found that despite a high number setting 2050 net zero target, only 34% thought they would achieve it. The survey found a delivery deficit in 68% of the organisations, which is a gap between intent and the ability to execute. Speaking from Seattle, Microsoft's Chief Environmental Officer Lucas Joppa describes the number as worrying. The survey finds that Aussie companies were strong adopters of renewable energy and sustainable supply chains, but lagged in tech innovation, decarbonisation, funding, skills and natural capital accounting. In Australia, the world's largest exporter of alumina announced a ban on shipments to Russia in a move that will add further pressure on aluminium giant United Co. Rusal International PJSC. Australia accounts for nearly 20% of Russia's supply of alumina, the government said on Sunday. Alumina is a key ingredient in producing aluminium and is in turn produced from bauxite ore. Exports to Russia of alumina and aluminium ore, including bauxite, have been banned immediately. While aluminium has not been targeted by sanctions, Rusal, which needs bauxite and alumina to feed its plants, is facing disruption to its supply chains as companies pull back from doing business with Russia. Rio Tinto Group plan to stop supplying bauxite to and buying alumina from a Rusal plant in Ireland. In Australia, Rio operates the Queensland Alumina Limited joint venture with Rusal, which holds a 20% stake. The London-based company said previously it was evaluating its options regarding the partnership with Rusal and had the appropriate structures in place to ensure Queensland's alumina operations would not be disrupted. And the strength of post-pandemic economic recovery will bring a $30 billion improvement to the budget bottom line this year, but whoever wins the federal election in May will face 15 years of deficits and need to find savings of $40 billion a year in the next few years. The surge in global commodity prices, including iron ore, coal and gas, will add about $45 billion in additional revenue, supporting an $87.6 billion improvement over the 4-year forward estimates. The budget will still contain cumulative deficits of more than $250 billion and spending at a historically 26% of GDP, according to Deloitte budget economist Chris Richardson, and that is before likely new spending on defence, aged care and the National Disability Insurance Scheme. Mr Richardson said savings of $40 billion a year by 2026 could easily be achieved without weighing too much on economic growth, in part because it could offset the need for interest rate rises in the future. Analysis by PwC Australia Chief Economist Jeremy Thorpe puts the upcoming budget improvement at just $20 billion in 2021-22, but he forecasts cash deficits for at least another 15 years out to 2036-37. Russia's invasion of Ukraine, while driving up the cost of oil and hitting households at the petrol pump, has forced the price for key Australian exports, including coal and gas, higher, while iron ore is also elevated. The prices for thermal and metallurgical coal are more than 50% and 60% higher than previous records, while iron ore north of US $130, that's 175 Aussie a tonne, is well above the budget forecast of US $67.50. And scammers have become more sophisticated in duping an increasing number of Australians who lost more than $38 million last month after falling victim to fraudulent schemes ranging from investments to romance. The latest available figures from the Australian Competition Consumer Commission's ScamWatch site also showed it received more than 18,300 reports in February, with people racking up losses of $38,106,474. The most prevalent scam involves investments through which more than $27,700,000 have been lost. Australians lost a total of $323 million in 2021. The consumer watchdog on Friday launched unprecedented legal action against Facebook owner Meta for publishing scam cryptocurrency ads featuring well-known Australians, including former New South Wales Premier Mike Baird, businessman Dick Smith, TV presenter David Koch, and mining magnate Andrew Forrest. Describing the federal court action as world-leading, Australian Competition Consumer Commission Chairman Rod Sims said he expected the case alleging Facebook had engaged in false, misleading or deceptive conduct by publishing scam advertisements. The ACCC said it knew of one consumer who lost more than $650,000 on a fake investment opportunity that was advertised on Facebook. Mr. Sims said an increasing focus on celebrities and crypto scams has risen very quickly and is a major problem and must be dealt with by the platforms. There's also been an increase in finance scams more generally. And hotly contested federal electorates were showered with millions of dollars more than safe seats received them from a controversial urban congestion fund, an analysis shows. And Victoria's been consistently shortchanged when it comes to federal transport initiatives, which favoured Queensland and New South Wales, where federal elections tend to be won and lost. The analysis of pork barrelling, promising public funds to particular seats for political gain, by think tank the Grattan Institute, shows the average marginal urban seat has received $83 million from a $4.9 billion urban congestion fund. The average safe coalition seat received $64 million, while safe Labor seats got $34 million. The analysis takes broader aim at transport promises at elections, with only one of 71 coalition major projects worth more than $100 million promised at the most recent federal poll, having a business case approved by the advisory body Infrastructure Australia. Labor was little better, with just 2 business cases out of 61 mega projects promised, and its transport spending promises were worth more. And thousands of workers are set to have their pay rises jump to 5% or more this year because of CPI-linked agreements that could shake up years of stagnant wage growth. About 30 blue-collar enterprise agreements approved in the past 6 months are underpinned by inflation guarantees, including for major logistics companies such as Global Express and Australia Post StarTrack, as well as employers in manufacturing, food, maintenance, construction materials and energy sectors. Most of the pay deals will automatically pass on the CPI rate recorded for this June quarter, which is forecast to spike at 5% or more due to rising commodity prices following Russia's invasion of Ukraine. The expected pay surge contrasts to the flat wage growth in most private sector agreements for the past 2 years, with the latest data showing pay rises continue to stagnate at 2.7% as of the end of last year. CPI-linked pay rises, once popular in the 1980s, are still relatively uncommon, but they experienced a revival during the industry bargaining for the parcel delivery sector in the second half of last year. Transport Workers Union National Secretary Michael Caine said thousands of delivery drivers achieved CPI safety nets in their agreements after taking industrial action, including Toll, Linfox, FedEx, Global Express and StarTrack. While some CPI-linked pay rises are capped at a certain amount, others are not. And the costs of replacing a damaged home in the flooded areas of southeast Queensland and northern New South Wales could rise at least 20% by the time work starts, as a shortage of skilled labour and materials escalates, experts say. The price tag could climb even higher, particularly for areas located further from the major centres, such as in northern New South Wales, warned Matthew Walker, CoreLogic's head of insurance solutions. Experts estimate the number of flood-affected homes had risen to 30,000 so far, and about 5,000 homes needed to be replaced. This is on top of the 22,241 homes built each year on average in southeast Queensland and northern New South Wales, according to the Housing Industry Association. And influencers have been warned that they must comply with financial services law or risk substantial penalties, and they should think carefully about their content. ASIC has issued an information sheet setting out expectations for social media influencers discussing financial products and services. A survey the regulator conducted last year found that 33% of 18 to 21-year-olds follow at least one financial influencer on social media, and 64% reported changing at least one of their financial behaviours as a result of following an influencer. The information sheet says information presented in a way that conveys a recommendation would be considered financial product advice, in which case the influencer would need an Australian Financial Services licence. A social media post saying something like, "I'm going to share with you 5 long-term stocks that will do well which you should buy and hold," would likely be considered financial product advice. Any misleading conduct would be a breach of the law. In this context, a misleading statement is one that cannot be substantiated. And Energy Minister Angus Taylor will accelerate its $7 fossil fuel project despite the UN chief describing such a move as madness while naming and shaming our measly climate action. Taylor says skyrocketing gas prices in Europe, up 300% at the moment as Russia supplies about a third of its needs, prompted him to fast-track grants to the local gas projects in Queensland, New South Wales and Victoria, saying Europe was a warning for us. It's part of a $50 million funding boost for the industry. It comes as UN Secretary-General Antonio Guterres slammed Australia at a London climate summit, saying a growing number of G20 developed economies have announced meaningful emissions reductions by 2030, with a handful of holdouts such as Australia. Ouch! The Climate Council said it's very unusual to see Guterres call out a country by name. The UN chief continued that it would be mutually assured destruction if countries turn to fossil fuels like coal or gas to patch up the gas caused by Russia's invasion. And that's it for this week. And next week I'll be talking to Andy Thiss, head of Anaplan ANZ. Anaplan is a planning software company used by leading ANZ enterprises across CPG, retail, finance and healthcare to help these companies better plan for the future. And I'll be talking to Rabobank economist Michael Every about the impact of the Russian invasion of Ukraine on the global economy. In the meantime, you can catch me on Facebook, Twitter, Instagram and LinkedIn. And if you want, leave a comment. Wishing you all a safe and healthy